In this example, we're looking at Kendall County and a lease that they have to finance computer equipment used in government offices. The lease is for 3 years, and county officials are reasonably certain that funding and approvals will be renewed annually for all 3 of those years. We have a payment of $150,000 made at the beginning of the lease, and then 2 additional lease payments of $150,000 made near the end of each year. The total amount to be paid under this lease is $450,000. And the lease agreement has an annual interest rate of 3%. Therefore, the present value of the lease is $437,020, and the fair value of the equipment of the lease is $445,750. Okay, so we're going to look at the lease, so end of the first year. So first, entries are required to record the beginning of the lease in the general fund, the debt service fund, and the government activities fund. So for 1, we'll do general fund, and then we'll put debit and credit for our journal entries. So for our general fund, we have a debit to expenditures for the present value. And then credit to other financing sources leases. Okay. In the debt service fund, we have a debit to expenditures, principal of lease obligation, and then a credit to cash. So at the very beginning, we're just recording. This is what happens when I try to type too fast, but we're just recording the $150,000 payment at the beginning in the debt service fund. And in the governmental activities, we now have leased assets, lease obligations payable, and that we've already paid cash of $150,000. Okay. Next, we have the entries required to record the payment at the end of the first year of the lease in both the debt service fund and the government activities journal. So we're recording the first year's payment. So in the debt service fund, we're going to have expenditures, interest on lease, and expenditures, principal, of lease, and then a debit cash. So we have the total payment is $150,000, and then remembering that we have our payment divided into interest and the principal amount. In the governmental activities, we have expenses, interest on lease, our lease obligations payable, and we have paid cash. Okay, so remembering that that has a 3% interest. So we have which financial statements prepared at the end of the first year would show both the asset and the liability related to this lease, and at what amount would they be recorded. So we have the asset and long-term liability only on the government-wide statement of net position, and then at the end of the first year, the liability would be reported net of the first payment of principal, and this would be on at 287.20. And so the calculations that we get from these, we would set up similar to an amortization payment or table, where we have years 1, 2, and 3, and then we have equal payments of $150,000. We have 3% interest on balance, unpaid balance. And then we have payment on principal and the ending balance. So at the beginning of the lease, we had this obligation of $437,020. We paid a payment on the very first day of the lease, net of interest. So we had a payment of $150,000. So our ending balance on the date of inception would take our beginning minus the $150,000. Then we have the interest amount, which is 3% on the unpaid balance. So that's our $8,611. We then, what goes against the principal is the difference between the payment and the interest. And then our ending principal balance is beginning principal minus the amount paid on principal. Then we have second year interest and the amount applied to principal. And then we should have a zero balance at the end of the third payment. So that's the table for that lease obligation. Okay. We're going to start on the problem from 626. So it's the chapter at the very, very end of chapter 6, the last problem, the comprehensive problem. And so we're going to start this. There are a lot of journal entries, so we're probably going to separate this into, we'll see how far we get into the different journal entries. So here we're looking at a service fund, a debt service fund, and recording transactions against it. So this fund is a serial bond issue to renovate our town hall. We also have a government grant. And so we have a series of entries, and this is this video is going to only be journal entries. That's what we're looking at. But we're looking at those journal entries in the debt service fund, the capital projects fund, and the government activities. So what we're going to do is we're going to separate these out. So we have debt service fund, and then the capital projects fund. Okay, and then so we're going to record each journal entry across these different funds. So one at a time. First, we record the 2023 budget for the Serial Debt Service Fund. Sales taxes of $350,000 are expected to be collected in 2023. The only appropriation is expected to be 6 months of interest on our serial bond. So that serial bond was $2.5 million, 5% serial bond issue. Then we get $1.5 million from a state grant and $1 million from the general fund. So transaction 1, then in the debt services fund, we're going to have estimated revenues. And then we're going to have appropriations and our budgetary fund balance. So those estimated revenues of $350,000. Appropriations for the interest, so that 5% interest on those bonds, and then the difference being the budgetary fund balance. One too many zeros there. Okay, in the capital projects fund, there is no entry for one, and in the governmental activities, no entry. Now we're going to look at the second journal entry. So we have the town transfers $1 million from the general fund to a newly established capital projects fund. So we have no entry in the debt service fund. We have received cash in our capital projects fund. And then we have, that was other financing sources, which I'm going to abbreviate, interfund transfer in for $1 million. And not do both rows, of course not. And in the governmental activities, we're going to have no entry. And now transaction 3. So if we read transaction 3, planning and architect's fees for the town hall renovation are to be paid in the amount of $200,000. So there's no entry in our debt service fund, as this is only part of the capital project. We have construction expenditures that we paid in cash of $200,000. And then in the governmental activities, we are going to have construction work in progress and cash for $200,000. Entry 4. So 4, we have the town hall renovation construction contract is awarded to a local contractor, Central Paving and Construction, for $4.5 million. So we have no entry in the debt service fund. And in the capital budget fund, we have now encumbered. So we have an encumbrance of $4.5 million and an encumbrance outstanding of $4.5 million, and there is no entry in government activities. Okay. Transaction 5. So on April 1st, 2023, the town issues serial bonds with a face value totaling $2.5 million, and we have maturities ranging from 1 to 20 years at 102, so at a 2% premium. We have interest of 5% per annum payable semi-annually on April 1st and October 1st. Premiums on bond issues must be directly deposited in the debt service fund and are restricted for debt service. Premiums are amortized using the straight line method over 40 interest periods. So let's do transaction 5, and then I'll switch to a new video for the rest of the transactions. So in the debt service fund, we have received cash of $50,000. So remember that that is just the premium. So other financing sources, premium on bonds, and then estimated other financing sources, premium on bonds, and budgetary fund balance. For the construction project, we have received cash of $2.5 million. One too many zeros there. And we have proceeds of bond. Other financing sources, proceeds of bonds. $2.5 million. Then we have in the government activities, we've received cash of $2,550,000. We have a premium on bonds of $50,000, and we have bonds payable of $2.5 million. Okay, so that is through transaction 5. Because this video is getting to be close to 20 minutes, I'm going to do the rest of the transactions on the next video.